Hey, this is Jake and JD with Peace Home Offers, and if you are wondering how in the hell to successfully invest in real estate in a down market, then this video is for you.
So the first things to understand in a down market is that not only when prices are dropping fast and the sellers start to get this idea like, hey, my property's not going to be worth as much as it used to be, then intuitively we know that there's going to be less people trying to sell. Another issue is that when people do try to sell, people know that the values are dropping, so they're not buying as much, which means that when you put the property back on the market, that it's likely going to sit on the market longer.
Yeah, to that point, while there will in fact be less people trying to sell their homes, they know the situation, they know they're not going to get as much for it. But to that point, the people that are trying to sell their homes are going to be that much more motivated. They know they're trying to sell their homes in the down market. That means they probably need to sell those homes, which traditionally results in better buying opportunities for us that are buying homes at the moment.
There's many different exit strategies in real estate. Let's start with rentals. In a down market, we know prices are falling fast, which a lot of times that means that interest rates are high. And when that happens, a lot of investors kind of decide to hold back and they don't want to really buy as many properties. My personal opinion is that you should just keep buying as long as it fits your buy box and don't worry about the interest rate, because you can always refinance down the line.
Basically, if you think about the way the market was last year, say, versus today where interest rates were low, today they're a little bit higher. So last year, let's say for example, you were to buy a house at $400,000. If it was listed at $400,000, there's a good chance that house is going to bid up to $450,000. So now you just paid $50,000 extra dollars. Yes, that was at a better interest rate. So what that same deal looks like today is there's a house list for $400,000. There's a good chance you're going to get that house for $350,000 or $360,000. So not only did you just save about $100,000 on a house, but you have that higher interest rate. Now you can refinance that interest rates inevitably. There's no guarantees, but probably the interest rate's going to come back down. So what you just did is saved $80,000, $90,000, $100,000 on a house. You got to suck up that higher payment for a little bit, but then when the interest rates drop down, pretty much you're going to be a happy camper at that point.
And actually, sometimes, not always the case, but sometimes, to what he says, is you'll wind up actually paying the same amount monthly for the mortgage, because you might have a lower interest rate, but now the purchase price of the home is much greater.
Exactly.
So therefore, it sometimes might be a bit of a wash. If you're buying it at a discount but at a higher interest rate, or buying at a high purchase price but a low interest rate, you're not going to save too much. So again, my philosophy would just keep buying.
And if you happen to know somebody like JD and myself that continuously buys houses at a steep discount, you can reach out to us and we'll make sure to pass that discount on to you.
Another exit strategy is for the flipper. So during a down market, as a flipper, what you're going to typically see is once you've rehabbed the property, you put it back on the market, it's typically going to sit longer. Another factor to consider is that the value of the property may continue going down during that time. So the longer it takes you to rehab the property, get it back on the market, and then possibly have it sit on the market a little bit longer than usual, your money costs will typically continue to go up, which is not necessarily a good thing. So I do recommend buffering yourself, adding in a larger margin, buying at a steeper discount, and really focus on that 70% of ARV minus rehab costs. Another factor to consider is previously you could go ahead and run your comps and you look at the highest comp in the area when the market was going up rapidly, because by the time you get it on the market, it's possible that the price or the value of the property has gone up. However, in a down market, you need to be a little more careful. So when you're running your comps, for example, if your comp is listed at 425, but it's been on the market for 90 days, you obviously want your property to sell as fast as possible. So when you're running your numbers, you might actually calculate your offer at 400,000, maybe up to like 415 maximum, but use that as your ARV times 70% minus rehab cost to calculate your offer.
So JD pretty much broke that down pretty good, but in a nutshell, it's really just about adjusting your criteria when buying properties. So maybe last year you were looking at like 85% of market value minus the repairs. Right now we're doing 70, even 65% just to be safe. We don't really want to get caught with our pants down. And another way that you can hedge your bets while flipping homes is having different exit strategies. You may just want to flip that home, get in and out, and guess what? In this market, it may not work that way. So going into your flip, have different exit strategies. Know your financing options. How much can you get a refi on this? Look into debt service coverage ratio loans. Know what your rents are in that area to know if that is a viable exit strategy. And in my opinion, right now, be super careful and buy properties that you can exit as a rental if need be.
Another thing to add is currently we're not taking on major rehabs. If this got severe fire damage or something along those lines, or it's dang near a whole tear down, we would typically avoid those as well. We're looking for simple, straightforward rehabs.
So here at Peace Home Offers, another thing we're doing to possibly mitigate the risk of loss is, instead of flipping properties, we are opting to wholesale a lot of the properties. And if you don't know what that is, there's another video on exactly what that looks like. But what we've learned is that there are other flippers out there willing to buy the deals that we get. So unless it's a very cookie cutter, straightforward, solid, high spread deal, we are simply opting to pass those deals on to other investors, and most of these guys are happy to get those deals. If they're not doing direct marketing themselves, they rely on guys like us to find these steep discounts for them.
Yeah, for example, there's plenty of real estate investors out there. Number one, they might be using it as a rental. Therefore, the rehab costs that they have to get it to livable standards is not quite the same as rehabber or flipper that's wanting to put it back on the market and sell it to an end buyer. Another factor to consider is there's a lot of really large investors out there that have their own construction team and they're on payroll. So they need to feed the machine if they don't have deals going on. A lot of times that money comes out of their pocket to keep their contractors and subcontractors employed during this time. So they might be willing to take on larger, crazier rehabs, unlike smaller, lean investment companies like ours.
And as a wholesaler, it really pays to know those guys in your market who do have those big companies who will pick up these deals from you. That's what wholesaling all boils down to.
Another exit strategy that we're seeing more common recently is the seller finance or creative structure deals. Seller finance, sub to novations, things of this nature. As property prices continue to drop, you're finding a lot more sellers that don't have enough equity to sell in a traditional sense. We'll go ahead and create another video in the future all about creative finance.
So if you're, just to be clear, if you don't know what sub 2 means, it means subject to the existing financing. Not everybody knows what that means. And this works a lot of times when the seller has a little bit of equity, but not enough to sell the house with realtor fees, back payments, and things like that. There might be $50,000, $60,000 of perceived equity sitting there, but that's not a lot when it comes to selling the house. So subject to is just a creative financing method that allows us to come over, take over that loan, get the seller maybe a little bit of cash so that they can move on to the next part of their life. And what we just effectively did is bought a house without having to get any of our own financing. And as JD said, there's more and more of those deals popping up at this very moment just because of the way the market is.
Right. We would like to keep sub 2 deals, but the factors to consider are the upfront costs, the amount of money to pay off potentially the arrears if they're behind in payments, and their exit amount. So maybe they say, hey, in order to get on with my life, I need $5,000 to walk away with. So again, our upfront costs and the cash flow. What is the mortgage payment based on what the market rent is? Is there enough spread there for a good deal? If it's very, very tight, we may typically look to wholesale the property to another investor that has a different exit strategy.
And so as with most real estate deals, it just becomes about knowing the basics and doing some math and finding out what works for you or potentially another investor and moving that deal however seems best.
So Jake, if people want to get a hold of us, they need help on deals or they want to JV with us, how can they find us?
One of the best ways is to go to our Facebook group, All Things Real Estate Las Vegas. You can find us there and a lot of good other information, as well as go to jvlasvegas.com. On that site, there's a lot of information about how we can partner up.
Yeah, all these links will be in the description below. And we also are currently using 34 different ways to find motivated sellers. So we're looking for a few good people that we can help train on one of those methods and then partner on deals with. If you're interested, please contact us. Probably through the Facebook group would be the best.
All right, thanks for joining us, and stay tuned for future videos on creative real estate and what we're up to moving forward.
See you soon.